Happy Monday, everyone, and Happy New Year. As we kick off 2025, the Federal Reserve is making some key changes, and this week is packed with market-moving news. Let's dive into the updates that are impacting monetary policy, interest rates, and of course, the housing market. So, the Federal Reserve's annual rotation of voting members is now in effect, and the changes could influence future rate decisions. Here's what's happening. The outgoing members are Richmond's Thomas Barkin, Atlanta's Raphael Bostic, San Francisco's Mary Daly, and Cleveland's Beth Hammock. They all lean hawkish, and they are all now out. The incoming members are Chicago's Austin Goolsbee, known as the most dovish member. He joins the voting group along with Susan Collins from Boston, Alberto Mussolem from St. Louis, and Jeffrey Schmid from Kansas City, who they do lean a little more hawkish. This shift adds one more dovish vote to the Fed's decision-making, which could help push for rate cuts, especially if the labor market weakens or inflation eases further. Now, let's talk about jobs data in the labor market. The Fed continues to keep a close eye on the labor market, and this week's data will be critical. On Tuesday, tomorrow, the JOLTS report, which measures job openings, will be released. On Wednesday, we have ADP's Employment Report, which it's expected to show 140,000 job creations. And on Friday, the big BLS Jobs Report, with expectations of about 160,000 job creations and unemployment rate holding right around 4.2%. These numbers are pivotal because the Fed has emphasized the importance of the labor market in guiding their decisions. A weaker job report could push rates lower, while stronger numbers might delay rate cuts. Now in housing news, rents continue to decline. Apartment List National Rent Index shows that rents are down about 0.6% month over month and year over year, with rents now nearly 5% below their 2022 peak. This is great news for inflation metrics and could lead to further cooling in shelter costs in CPI and PCE reports. Mortgage rates, however, they hit a 6-month high. Freddie Mac reports that the 30-year fixed-rate mortgage climbed to 6.91% last week. It's the highest since July. Rising bond yields have driven this increase, which has also impacted mortgage applications. According to the Mortgage Bankers Association, applications dropped nearly 22% in the last week of December, with refinances down 36% and purchase loans down 13%. A lot of news out there. Now let's look at the Treasury and bond market. This week, the Treasury is auctioning about $119 billion in bonds, including the 10 and 30-year auctions that are key for the mortgage market. The level of demand will be critical, as it could put additional pressure on bond yields and mortgage rates. Currently, the 10-year Treasury yield is up slightly to 4.62%, while mortgage-backed securities are holding steady. Watch for any shifts as we progress through the week. As we move into 2025, the rotation at the Fed, this week's jobs reports, and ongoing housing market trends will set the tone for the months ahead. Stay tuned for updates, and as always, feel free to reach out with any questions. Thanks for watching, and here's to a successful start to the new year. Take care, everyone.